Welcome everybody to our update on our property briefing that we had a month or so ago. We thought it was quite pertinent to welcome Adam Murchie back with Matt Gibson from Discover Wealth and myself, Justin Lastouris. So welcome Adam, thanks for joining us again today.
Thank you, particularly after I did the Houdini last time, disappeared in a puff of smoke, courtesy of a Zoom dropout at my end.
Can you guarantee you won't be leaving us during the presentation?
Nothing in life is guaranteed, mate. We all know that. So we'll hopefully we've got it sorted this time.
That's great. We're going to keep today punchy for everyone, sort of five to 8 minutes. But I thought just before we start, Matt's got a couple of questions for us that you could just recap for our listeners how commercial property is valued in the current market or generally in relation to yields and rents, etc.
Yeah, precisely. So it's a good question, and it's particularly timely given everything that's happening with inflation and interest rates. So, and I mean, at its most basic level, the property valuation is derived from two primary inputs: rent and the cap rate applied to that. And there's the cap rate, sort of the inverse of the yield, if you like. So what I mean by that is, at the most basic level, if you've got an income of $100 and you've got a cap rate of 10%, you've effectively got a property value of $1,000. So what happens is, as your cap rate tightens, your property values increase, and that's what we've seen in commercial property since the GFC. There was an absolutely outstanding chart in the Financial Review last week. I think it was Wednesday. I can dig that out and share that if you like, Matthew and Justin. But
yeah, that'd be great.
It really, what it showed was that point I made at the start of my session around the stack of property, where it used to be the cheapest or least valuable was industrial, office, retail, has completely inverted. And then there's this massive inflection point around the time of COVID in early 2020. I mean, the chart, quite frankly, my head fell apart when I was looking at it. And what it shows is then how much industrial has accelerated. And what it also shows is the relativity of cap rates to pricing. So it shows that as the cap rate for industrial has tightened from nearly 9% to now somewhere in the circa 3.5 to 4, their values, the value of industrial properties increased by 2.5 times. So, I mean, it's quite staggering. And so it shows this sort of relativity then between, as interest rates have fallen, cap rates have fallen lockstep with it. And what's happened is property valuations have increased hugely over the last 10 or so years. Now we're at an inflection point the other way. Inflation's increasing. There's an argument that as inflation increases, not an argument, it's a very strong causal relationship between inflation increasing and interest rates increasing. And whilst we're having this discussion, the RBA is probably about to make an announcement on interest rate increase. I hope that they do, because I think the market probably needs it. What that means is when you start feeding that into valuations and cap rates, they potentially start softening. So what then do you need to maintain a property's valuation in an environment where cap rates are softening? You need market rent growth. And I don't think we're there just yet, because there's still a bit of vacancy around the traps, less so in industrial, more so in office and retail. But what is happening in this current environment with increases in interest rates, increases in every supply chain input there is, labour, materials, time, it's going to make new development really, really hard to stack up. And what that means is that new development gets pushed to the side for the time being. And what happens is, until that new development becomes viable, market rents across the board will lift until it hits the inflection point where new development becomes economically achievable. So we sort of think that near term, you're going to have a valuation squeeze point across the broader commercial markets, but longer term parts of that market are actually going to have, we think, quite a strong tailwind in the form of rental growth.
So if you're an investor looking at, or even a business owner that's looking at buying a commercial property to house your business, how do you approach this sort of, surprised market where you've got so many variables that are moving so quickly?
Yeah, it's a bit of a loaded question, right? It's like someone asking me, I always find a good way of doing this is with examples. So, I'll use Resi as a proxy for a commercial owner occupier. So, guy I know very well, he's the CIO of a family office, and he's telling me he was struggling to get into the residential property market. And I said to him, well, the problem is that you're going to the auction and you need to send your wife. I said, you're coming at it purely from an economic point of view, and she's coming at it from more of a lifestyle and a life choice point of view. I said, they can be opposing forces. So that's what he did, sent his wife to the auction. They bought the house, and his rep reckons the best thing they've ever done. They're well in the money. Why I say that is it's for a commercial owner-occupier, it's a not dissimilar discussion. There's an economic piece to it in terms of can you buy the property well, but there's a piece that sort of transcends the property financials or fundamentals in that how important is that location or that specific property to your overall business objectives. So there's a little bit of a divergence there, but I do think that we're heading into an interesting environment. I think that there is going to be some interesting buying opportunities. I don't know that they'll necessarily be wholesale. There is still an unbelievable sum of money sitting on the sidelines. That being said, there was also pre-GFC. So it's one of those things that the market's great until it's not. No one ever really tells you when that inflection occurs. But we do think on balance that, well, we're hearing anecdotally at the moment from real estate agents that on assets where there might have been 6 to 8 willing participants, there might now only be 2. And the predominant line of feedback there is it's being driven by the increasing cost of interest rate. And when that's plugged into a financial feasibility, they can't hit the asking price. So we're sort of seeing at the coalface, not so much a softening in price at the moment, but a softening in demand. And that there tends to be a lag. That'll take a little while to play its way through the market.
I've heard that from residential agents as well. The number of people viewing or turning up for an auction all around Melbourne is definitely softened from where it was 6 or 12 months ago.
Yeah, and I think the other thing that's interesting at the moment too, there's been a bit of a disconnect in terms of, I think there's a fair bit of short-term debt in the market, and I've seen some funds in recent time going out with the interest rate at just the 30-day swap rate. So that's great now, and it's cheap relative to the 3-year rate, but then you're unhedged to that risk on the way through. So the yield that you've got today is quite possibly not the yield you're looking at in 6 or 12 months' time. So we sort of see that as interesting. People are sort of trying to price things at the moment to make the front end look great, but taking on quite a bit of tail risk at the back end.
Well, I guess for the owner-occupier, coming back to them, I think that was a great point you made, that if it makes sense for the owner, there's other attributes to consider in a purchase. But I guess if you've got the ability to hold an asset through that initial tough period, then there is the reward of increased rents potentially, or the potential to lease that asset for increased rents in the future anyway to other third parties, and that underpins long-term value creation. I guess that's ultimately aim of the game anyway.
Oh, spot on. I mean, the best equation in property is time. The longer you hold these assets, it's one of the I won't say frustrations, but the friction points we have as a fund manager. I suppose from an investor's point of view, and I completely understand why, there's a natural inclination to want to have a 5 to 7 year investment horizon. But if you look at what a lot of the wealthy families do, and particularly those that have made their money in property, it's been by holding assets for 10, 15, 20 years. And often you get some of the real growth outside of that initial 5 to 7 years. So we're always trying to pick the eyes out of the market and find stuff that works. But often we sort of look at an asset where you go, there's an obvious point of exit now, but you also know in 5 or 10 years' time, that asset will be worth significantly more than what it is now. And I think that's true for commercial property. What certainly happened post GFC, and then after that, when there was the Greek debt crisis in 2013, if you can navigate these pinch points and hold the asset, long-term you benefit really well. And one of the best examples, and I used it yesterday in a session I did, was there was Centro, which was probably the epic implosion of the GFC, predominantly shopping centres, bought another business called MCS, which was very similar to Forza. It was more a traditional syndication style business, and they owned individual standalone shopping centres. Now, Centro burned to the ground, but the MCS syndicates kept running outside of the charred remains of Centro. And going into sort of 2013, 14, 15, a lot of those assets were divested and the original unit holders did really, really well. So they were well set up, those assets. They navigated the market squeeze and came out the other side and did famously. And we always say it's not whether you do or don't participate or ride through a cycle. You're always, if you're an investor, going to ride through cycles, but it's how you navigate that and how you maintain control of the asset. That's absolutely the most critical thing in what we do. How do you maintain control of your asset when a market gets a little bit soft?
Fantastic. That's great, Adam. Great insights. Nice to just have a punchy chat with you and get to the bottom of the issue. I think there's plenty in that, really, what we've covered. So
yeah,
fantastic.
We'll update everyone a bit later in the year as well once we see a few rate rises. So thanks for your time today, Adam, and hopefully everyone's enjoyed watching. Thanks.
Thank you.
Bye.